Welcome back to Investing Talk Podcast.
Great to be here.
We are tackling a single, pretty high-stakes question today, and it's all based on the materials you, our listeners, sent in. Is your energy a good time to buy right now?
Exactly. And this company, Energy, it really presents a classic growth investment case, but it's balanced on what looks like a contradiction. We've gone through the analyst reports, the financials, news clips you sent.
Yeah, we synthesized all that stuff.
Right, to really focus our analysis today and break down the mechanics of this uranium producer story.
And the core issue, the tension here, it's really undeniable, isn't it? You've got this small-cap player, Energy, with just explosive revenue growth. We're talking, what, 90.7% year over year?
Astonishing growth, yeah.
But at the same time, they're showing a really significant trailing 12-month net loss, almost $60 million in the red.
Negative $59.92 million, to be precise.
So our job today is pretty clear. Figure out if that huge spending is, a necessary investment for future dominance, or if they're just burning through cash.
We'll connect that fundamental growth story with the financial risk profile and try to explain why analysts seem so confident despite all that red ink.
Okay, but before we dive into the numbers, just a quick reminder. Please subscribe, like, and comment on this analysis. It really does help us out a lot.
It does.
And hey, if you have another company, a specific one you want us to look into like this, just leave a comment below. We really do prioritize those suggestions.
Absolutely.
All right, let's get started. Section 1, the fundamentals. And that means tackling that growth story head on. The trailing 12-month revenue TTM, as we call it, for Energy, is sitting at $39.49 million.
Yeah, but the number that really jumps out, the one getting all the attention, is that year-over-year acceleration. Their 2024 revenue was $33.71 million, which is up from $17.68 million the year before. That's at 90.7% growth rate. You just don't see that every day.
No, you really don't.
And it puts them right up there among the leaders in their small-cap uranium peer group. It shows they're definitely capturing significant market share as this global demand for, secure uranium supply keeps growing.
Okay, incredible top-line growth.
Yeah.
But then you glance down the income statement, and the picture gets quite a bit darker. That profitability puzzle you mentioned, a trailing 12-month net loss of negative $59.92 million. And this is the critical part, right? This loss isn't shrinking. It actually increased by 73.5% from the previous year. Now, if I'm just looking at the raw numbers as a potential investor, that ballooning loss is a huge red flag.
It absolutely should be a red flag, or at least something that makes you pause, unless you understand the context behind that spending. And this is where digging into the source material really pays off.
Right.
That increased loss. It's almost entirely attributed to front-loaded capital expenditures. Think ramp-up costs, expansion costs. They're not bleeding money because sales are bad. They're investing really aggressively to expand their production capacity.
So they're essentially trading these short-term accounting losses for, hopefully, massive long-term scale.
That's the idea. It's a strategic bet.
Can you explain a bit more why that 73.5% jump in losses is supposedly necessary for their model? I mean, it sounds pretty reckless without understanding the why.
Yeah, good question. It connects directly to their mining technique, which is called in situ recovery, or ISR.
Okay, ISR.
Right. So unlike traditional mining where you're digging massive pits or shafts, ISR involves drilling, hundreds of specialized wells, injection wells, recovery wells across the ore body.
Okay.
And that drilling campaign, before you even start extracting significant uranium, is incredibly capital intensive, CapEx heavy. The analysts are suggesting that 73.5% jump reflects a deliberately accelerated drilling and development push, probably at their main Lost Creek facility.
So it's like taking on debt now, but debt in the form of upfront costs.
Exactly. Strategic debt to future production. It should guarantee faster and, importantly, lower cost extraction once those well fields are fully developed and the processing kicks into high gear.
Got it. So they're hitting the accelerator on spending, betting the uranium market stays strong enough to make it all worthwhile down the road.
That's the bet. And the analysts. They seem to be betting right alongside them. You've got a consensus of 4 research analysts, based on the sources, assigning a strong buy rating to Energy.
A strong buy even with those losses.
Even with the losses. And they're projecting a 12-month average price target of $2.50. Now, compared to the current price, that's suggesting something like a 54% upside. Clearly, they're looking past the current red ink towards those future projected cost structures.
Okay, let's talk about that future cost structure then. Current margins have obviously taken a hit because of all this investment spending. But what's the long-term picture look like for profitability once they actually hit scale?
Well, the sources seem pretty consistent on this. They indicate that Energy's long-term mine operating cost structure, thanks to that ISR method, is expected to be highly competitive, even globally.
Totally competitive.
Yeah.
Yeah.
So once that new production capacity is fully ramped up and, optimized, meaning the infrastructure is built and they're just focused on pulling the uranium out, the economies of scale kick in. The operational efficiencies tied to ISR mean costs should drop significantly.
Materially improve is the phrase I saw.
That's it, materially improve.
Yeah.
And that's the inflection point everyone's watching for. That's when those current big losses are expected to flip pretty quickly into positive high-margin earnings.
Right, that transition point is absolutely key. But look, to actually survive this period of intense spending and reach that magic inflection point, they need really solid financial footing, don't they? Which brings us nicely to Section 2. Financial strength and their competitive moat. How stable are they?
They actually appear pretty robust, surprisingly so perhaps, given the spending. The balance sheet shows a solid cash buffer. That's critical. And especially when you compare them to some peers who might be more heavily leveraged, Energy has minimal long-term debt.
Minimal debt, okay.
That lack of heavy debt gives them flexibility, which is really important in a volatile commodity market like uranium. Their liquidity, their working capital, it significantly exceeds their short-term liabilities. The sources calculate that gives them an operational runway of at least 12 months.
Okay, a 12-month runway sounds decent. But, 12 months can fly by, especially in commodities. And we're still seeing that persistently negative free cash flow because of all the capex. What happens if the uranium spot price, say, stalls out? Or if their expansion costs run higher than expected? Is there a risk they'll need to dilute shareholders down the line to raise more cash?
That's the right question to ask for any growth story like this, absolutely. And while negative free cash flow is, frankly, pretty standard during such an aggressive expansion phase.
Right, it's expected.
It is. But the analyst's confidence seems to rest on two main things here. First, that existing cash buffer minimizes the immediate risk of dilution. Second, and this goes back to the ISR model again, it's relatively asset-light compared to conventional mining. This means they should hit cash flow break-even much faster.
Faster than digging a huge pit, you mean?
Exactly. The sources suggest they could reach break-even with only, let's say, modest improvements in the uranium spot price from where it is now. That reduces the potential need for massive future capital raises, provided, of course, that their expansion timeline stays roughly on track.
Okay, that makes sense. Let's shift then to their long-term security.
Yeah.
Every great investment, they say, needs a moat. And in the U.S. uranium business, that moat often seems to be regulatory hurdles.
That is arguably their strongest structural advantage. Energy is one of the very, very few fully permitted uranium producers operating in the United States right now.
Fully permitted, that's key.
It's absolutely key. Their main facility, Lost Creek, is already approved for expansion. It's scalable under the existing regulatory approvals they hold. Getting new operational permits for uranium mining in the U.S., well, it's notoriously slow, incredibly complex, and very, very expensive.
So that difficulty basically acts like a barrier.
A formidable barrier to entry, yes. It means competitors can't just easily jump into the market to take advantage of rising demand. It effectively protects Energy's position, at least for the foreseeable future.
Okay, so they've got the regulatory green light, which is huge, and they also have that technological edge you mentioned. Remind us again how that in-situ recovery, the ISR tech, adds to their strategic advantage.
Right, ISR. It's really quite revolutionary for uranium extraction. The operational benefits are pretty profound. You get lower operating costs compared to digging ore out of the ground and hauling it.
Lower cost.
Faster project development timelines because the surface construction is just less complex. And maybe increasingly important today, a significantly reduced environmental impact. That makes it much more appealing in the context of global clean energy goals and ESG concerns.
Right. That efficiency means their future production should be very cost competitive.
Precisely.
And one last piece on their stability. They've apparently managed to lock in customer relationships. That must provide some baseline stability in the often volatile commodity world.
Yes, that's another important point from the sources. They've secured long-term sales agreements with major U.S. utilities.
Ah, the utility.
Foundational. It ensures a degree of consistent cash flow visibility, which insulates them, somewhat from minor bumps in the spot market price. And maybe more importantly, it demonstrates that these major U.S. power generators are actively prioritizing reliable domestic uranium supply. That's a preference that your energy is perfectly positioned to meet.
Okay, shifting gears now. Section 3, technical signals and momentum. We've laid out the strategic case, strong potential, despite the short-term financial pain from spending. Now, the stock itself, it's currently trading around $1.53. That's kind of near the middle of its 52-week range. What are the charts telling us? How are investors behaving right now?
Well, the broader technical picture, looking at the charts, it actually remains pretty bullish, even with this recent price consolidation, this sideways movement.
Bullish despite the price not really going anywhere lately.
Yes. If you look over the last 6 months, the stock has established a pretty clear pattern of higher lows that generally suggests consistent underlying buying interest, possibly from institutions accumulating shares quietly.
Higher lows, okay.
And we look very closely at things like the 200-day simple moving average, the SMA. Right now, that's acting as a sort of technical floor around $1.10.
And why is that $1.10 level, that 200-day average, so significant, especially for bigger investors, institutions?
Think of the 200-day SMA as representing the long-term average price, basically the institutional consensus view of the stock's value over roughly the past year. When a stock consolidates and manages to hold well above that line, like URG Energy is doing now,
Staying above $1.10.
right, it signals that the long-term money, the bigger players, still view the fundamental story positively. Now, if the stock were to break decisively below $1.10, that would be a major warning sign, a technical breakdown. But for now, it's acting as a strong support level, a kind of safety net.
Okay, that's the long-term picture. But the immediate price action, like I said, seems kind of sluggish, depressed almost, despite that positive fundamental story we just outlined.
It is. I'd say it's deeply depressed, technically speaking. We look at an indicator called the Relative Strength Index, the RSI. It measures momentum. The sources show URG Energy's RSI reading is currently at 24.91.
24.91. And what does that number actually mean?
Well, remember, any RSI reading below 30 is generally considered to mean the stock is technically oversold.
Oversold, meaning?
Meaning the recent selling pressure may be from shorter-term traders or retail investors reacting just to those negative headline earnings numbers, has likely pushed the stock price down too far, too fast, relative to its underlying trend or intrinsic momentum.
Ah, okay. So that low RSI reading, the classic technical signal, isn't it?
Right.
Suggests the stock might be effectively on sale, assuming you believe the underlying fundamentals justify a higher price. What kind of trading dynamics does that usually imply?
Well, it often sets the stage for what traders call a reversion to the mean, basically a bounce back. You see elevated volatility right now, about 10.45% over the last 30 days, which isn't unusual for a commodity-linked growth stock.
Expected volatility.
Expected, yes. We'd anticipate the stock might trade in a range, say, between $1.30 and $1.85 in the near term. But that deeply oversold RSI, combined with the strong technical floor at the 200-day SMA, and importantly, the upcoming potential catalysts, it creates a scenario with a reasonably high probability for a powerful upward move, a breakout, maybe towards that $2.50 analyst target if some positive news hits.
Okay, that brings us perfectly to Section 4, key catalyst and speculation. We've got this potentially oversold stock, strong underlying story. What concrete events could actually trigger that market snapback, that breakout you mentioned, particularly in the short term?
The timeline here is actually quite specific, according to the sources. The most concrete, the most immediate potential trigger is the upcoming Q3 2025 earnings report that's scheduled for November 5th, 2025.
November 5th. Okay. What are people watching for?
Analysts have already sort of priced in continued strong year-over-year sales growth, but they'll be watching closely for confirmation that the expansion timeline is on track and maybe, just maybe, announcements of new long-term customer contracts. If they beat expectations on those fronts, that could absolutely provide the fuel needed for institutions to re-rate the stock upwards.
Makes sense. And beyond the company's own reports, you mentioned market flows often play a big role, especially in the fourth quarter of the year.
They certainly can. We've got anticipated ETF sector rebalancing that usually happens around late November, maybe November 22nd, according to some notes. And then there's the institutional buy window, which typically opens up in late December as funds finalize their positions for the year end.
How do those help URG Energy specifically?
Well, These kinds of macro market events can compel large index funds, sector ETFs, institutional investors to adjust their holdings. If Energy is seen as a well-positioned leader in a strategically important sector like domestic uranium, these flows can inject significant liquidity and buying pressure into the stock, naturally pushing the price up.
Got it. Now let's zoom out a bit. What about the broader policy environment? Are there any external tailwinds, government actions maybe, that could help this bullish thesis?
The macro policy environment in the U.S. definitely seems to be moving in a supportive direction for domestic uranium production. There are persistent rumors, mentioned in some sources, about potential Department of Energy DOE programs to purchase uranium, specifically to build up a strategic reserve and secure domestic supply.
Like a national stockpile.
Something like that, yes. And also talk of further domestic supply incentives. Now, as a fully permitted U.S. producer, Energy would be a direct primary beneficiary of almost any federal policy shift like that.
Okay, that could be significant. And operationally, any industry chatter about them potentially beating their own timelines, getting production up faster.
Yes, there is some mention of that. Industry chatter, speculation perhaps, regarding a potentially fast-tracked timeline for bringing early production online at their second major development project, Shirley Basin.
Emily Basin, right.
If that site could start producing sooner than the market currently expects, it would obviously boost the company's projected output, their overall revenue outlook, and potentially pull forward that profitability inflection point we talked about earlier. That would be big news.
And finally, everyone's favorite topic.
Yeah.
M&A buzz. Mergers and acquisitions. Is Energy seen as a likely takeover target in this environment?
Widely, yes, according to several sources. You look at their minimal long-term debt, their efficient ISR technology, and crucially, those highly strategic, already permitted U.S. assets. It makes them look like a very attractive, almost ideal acquisition candidate.
You would be interested.
Larger energy companies, maybe diversified miners, even utilities themselves who are looking to secure their own North American uranium resources without having to go through that incredibly long, uncertain, multi-year permitting process themselves. Buying Energy could be a shortcut. So yes, the M&A rumors are definitely circulating.
Okay, wow. This has been a really thorough look at what is definitely a complex story, defined by that strategic risk spending big now for future gains. So pulling it all together, what's the overall conclusion? What rating do we assign based on this analysis of the listener sources?
Based on synthesizing everything we've discussed, the really powerful growth, the financial stability that seems sufficient to weather the expansion phase, the technical signals suggesting it's oversold, and those near-term catalysts, we're assigning an overall bullish rating of 8.5 out of 10.
8.5 out of 10. That's a pretty strong conviction rating.
Right.
So for our listener, what are the, say, 3 core takeaways they should really lock in from this?
Okay, 3 things. First, focus on that explosive revenue growth, nearly 91% year over year. It confirms they are capturing strong market demand right now.
Growth, got it.
Second, remember their dominant position in the U.S. context, both regulatory with those permits and technological with the ISR advantage. That creates a deep, protected, competitive moat.
The moat, okay.
And third, those technical signs of being deeply oversold, that RSI reading down near 24. It strongly suggests the stock is currently undervalued relative to its potential, especially with critical catalysts like the November 5th earnings report just around the corner.
So it sounds like the stock could be attractive for 2 types of investors, maybe. Those looking for a quicker tactical trade based on the upcoming news flow in Q4.
Right. Playing the catalyst.
And also for long-term investors who are banking on that bigger picture, the secular shift towards clean energy and the need for secure domestic U.S. energy supplies.
Precisely. It seems to potentially serve both horizons, based on the analysis.
Which brings us right back to where we started this whole conversation, that growth versus loss paradox. So here's the final thought for you, the listener, to really chew on. Given that strong analyst price target consensus of $2.50, while the current price is hovering around $1.53, how much confidence should you place in that analyst's view when the company is, right now, reporting a net loss of nearly $60 million?
Understanding that specific risk versus reward balance. That's really the essence of this particular investment decision, isn't it?
It really is. Something to weigh deeply.
Indeed. Well, thank you for joining us for this analysis.
Yeah, thanks, everyone. We'll see you next time on Investing Talk Podcast.